Yes, but adding further to that, I think there is no doubt that this devaluation is going to increase prices across sector. This price is not only going to translate into the cost of inputs, but the consumers will feel the impact, because will the corporates be able to pass on these prices again to the consumers, or will it lead to reduction in corporate earnings? Bond yields definitely will increase, will spike, and you find a situation whereby, because of the reduction, the 20% reduction in the value of the stock market and not performing, there's clearly the opportunity for disintermediation between the equities markets and the money markets, and of course the bond markets, because the rates on deposits are going to go up, and if you make more, savings becomes more attractive. So there's no question that it will be inflationary, but my own concern really is the fact that we cannot continue to be in stability mode. We've been in stability mode for too long. You can't continue to be, the whole added saying about rope-a-dope with playing defensive, and we need to go on the offensive mode. We need to be able to grow this economy, because what is critical, in my own opinion, is the fact that the growth we're seeing is not enough to sustain unemployment and poverty reduction. There's no point in having growth that is not inclusive. If you take a look at the statistics of poverty and data, there's so many things in this country, including the infrastructure deficit, we need to come back. And that's why I keep coming back to the fiscal side of things, because it's the fiscal problems that we have that is determining the sort of policies that the central bank has to adjust to. So we need to move in sync on a growth mode to be able to do something instead of reacting. And as Bismarck has said, we need to look at a new way of the foreign exchange system. 50% of the foreign exchange transactions are now done on the interbank market, which is a very positive sign. But you still have the BDC and other black market operations. So we need to synchronize this and move the Naira into a more, what I would call, more convertible mode, or a more market-driven way, whereby we know the value of the Naira and stop the speculative attacks. But if you have so much Naira in the system, the liquidity is really what the issue is. All this Naira in the system is not productive. It's already gone into government bonds. The banks are pushing it into bonds, and there's not enough instruments. So you keep mopping up, and there's a cost. This Naira has to go into productive sectors of the economy to make things work.
But Mr. Adebayo, let me just cut you there. Let's talk about the trickle-down effect that this is likely going to have. We've been talking about most likely how it's going to affect middle to upper class. Let's talk about the trickle-down effect. Because you see, a lot of us go to the market on a regular basis, and we've noticed, just like Mr. Rwani actually pointed out, increase in food prices and foodstuffs and the rest of it. And this most likely is going to actually make food prices or other prices of commodities rise. How badly is it, or do you feel it's going to be?
Well, it's that's why I think the caution with trying to raise interest rates to be able to reduce the impact of inflation. If you take a look at all the consumer price index and the baskets in terms of food prices, I think this is one area where we've been very lucky, because even the insurgency in the north has not really affected or impacted on food prices. And the component of food we're talking about has to be separated between what we actually produce locally and what we import. So the impact on food prices will be on the imported segment of food. And I think that's why you're looking at the government trying to look at their import substitution strategy of reducing the dependence on import and trying to reduce the food import bill. But again, there's also the level of commitment. So if you take a look at the common man, or how does this impact the common man, it's not a pretty picture, because with every opportunity of anything, entrepreneurs try to use that opportunity to pass on all these costs eventually to the consumer. And I think from what I said earlier, the question is, if these costs are rising, who's going to absorb the costs? Are the corporates going to absorb it because that's going to impact on their corporate earnings? Or do they have the capacity to pass this increased cost on to the consumers?
Yeah, because some business owners have already started complaining. Immediately they heard the pronouncements. They're like, this is going to cost us more than usual. I might just decide to start right sizing, and this economy is not ready for this at this time.
Okay, I think one of the things that the viewers want to know is that how is this thing going to affect who's going to win in this, who's going to lose, and who's going to be neutral. So first and foremost, let's take the CRR. By taking 5%, by having a 5% increase in CRR, it comes to almost 400 billion
400
naira.
billion naira.
And that means the cost of that is about almost 40 billion taken off out of bank profitability for the next 12 months, in addition to the AMCON levy, in addition to the NDIC levy and all of that. So that's part of it. But what it does also is that it pushes up interest rates. So the level of savings, voluntary savings, will increase, and typically savings could lead to increased investment, but also it reduces consumption and it actually reduces demand for goods. So that is one part of it. The second part of it is that because the exchange rate has depreciated, people have to buy, the cost of imported finished goods will increase, the cost of airline tickets will increase and all that. So your balance of trade, which because price of oil went from 116 down to 79 or 78, the balance of trade was technically wiped out. That's the difference between your export and imports. And therefore, you have to now begin to depend on your reserves. But if you look at the reserves, in 2008, the reserves were $53 billion. It's now down to $37 billion. Other countries in our group, Angola and others, since 2008 have not only replenished their reserves, they've actually doubled their reserves since then. But we are still at about 50% of our all-time high on reserves. So there's no reserve replenishment. Our reserves are only 97% of our short-term liabilities, right? And 7% of GDP, right? And other emerging markets are having 11% of their GDP. So the picture, while it's fairly stable, also is vulnerable. And to deal with the vulnerability, you have to now begin to build buffers, domestic and external buffers. Those buffers is what you're going to use, because whether we like it or not, Nigeria has to go into a borrowing mode. Because you first of all start with monetary adjustments, you take fiscal adjustments, and then you go to structural adjustments. When you're going to borrow, the thing you're going to say, what is your financial condition? The financial condition of Nigeria is such that it has enough borrowing capacity, but it has not been able to show that it's what it did with the previous borrowings. So there are a number of issues there, and the monetary policy, again, will complement fiscal policy. And the monetary policy, like I said earlier on, is to stabilize things so that people will now know what to do. And one of the issues that you have to consider is that when the price of oil was 116, you were selling petrol at 97 naira a litre. Now the price of oil has come down to 78. Should the price of petrol still be 97 naira a litre, or how much are you going to bring it down? If you don't bring it down, because of the exchange rate, the actual landed price of petrol could go back up to about 90 naira or something. But definitely there could be an argument, one, either to forget about, since the subsidy has reduced, you can now forget about it so that it doesn't become a contentious issue. Or if you want to keep the subsidy, you can do that. But definitely one of the areas we're going to be looking at is what would the new price of petrol be under the new oil price and the new exchange rate. That's one issue that we need to resolve.
Okay, so let's take a quick break, catch our breath and come back. We've actually got some tweets that have come in, so I'd like you gentlemen to respond to that when we do come back from the break. You're watching Business Morning on Channels Television, and on the program today we're looking at the MPC's pronouncements, the implications for the economy. I've been having a conversation with an investment banker and economist at Tilewa Adebajo and the Managing Director, Chief Executive Officer, Financial Derivatives Company Limited, Mr. Bismarck Rwani. Both gentlemen are going to be here with me in the studio when I return in a moment. Please join me again.